Hello, everybody. This is Sashikant Valem from Valemwari Farms. VVF Bhoomi is a model where individuals can join us in buying the farmland with smaller investments. Farmland is a very valuable and secure investment. It always goes up, but never depreciates. It's true in many cases, unless there are situations of global recession and many unforeseen situations. But relatively, it's a safe investment. The population is on rise, more food is on demand, limited cultivable land. This increases the value for land. It's across the world. So VVF Bhoomi is a model that is created to bring multiple small investors with, when I say small, multiple investors with small capital to participate in large deals. Individuals may have 100,000 to invest, but it's always wise to invest 25,000 into four to five multiple deals so that one of it gets into a jackpot. It's good for everybody. So the model is structured in a way to ensure the smaller capitals are collated and then made into a larger capital to invest into the farmlands, which at some point of time turn into commercial real estate or residential real estate, something that appreciates to bring good return for the investment. The model is there would be a legal entity and a land will be purchased in that legal entity. Members, the investors will become members into the legal entity. This means that the individual member will not get a specific piece of land. They will get a membership interest into the legal entity that holds the land. For every asset, there would be a complete different legal entity and a unique set of investors in that. Same investor can invest into multiple legal entities, which means that they're investing into multiple land assets. This is to ensure that the profit and loss for that specific legal entity, because of the land appreciation, is provided only to those investors who are in that particular land. In this example, let's say an investor has $100,000 to invest. They can invest into multiple legal entities, which is owning multiple assets of land. Depending on which land appreciates, the investor will get the return based on the percentage of interest in that legal entity. This is done in the form of general partner and a limited partner. VVF acts as a general partner and the investor becomes a limited partner. This is the limited liability corporation that we create for each and every entity. There are two types of revenues that one can expect. There is a lease income and the land appreciation. Most of the farms, the lease income is very negligible. The importance of lease income is to ensure the property taxes are handled well. When the farm is given on lease to a farmer, either to cut the bales or to graze cows or for any activity, there is an agriculture exemption, without which this particular land would have to pay a property tax. And at the same time, when the land is given on lease to a farmer, it's well utilized. It's win-win for both. The lease income may not be significant. It's a fraction of percentage per year. So the idea is not to expect decent amount of cash flow on a yearly basis. If that's the expectation, this is not the deal for investors. The idea is when the land appreciates, when we sell the land, that's when we are looking at the capital returns and with the profit. Whenever we say profit, any business, it's all about profit and loss. Imagine a recession that happens. You will not be able to sell the land at an appreciated price. We may have to hold the land for more period, which means that your capital is stuck. So individuals have to understand this is not a one-way street where everything is rosy. There are possibilities of losses, but in the history of United States, one has to really look back and see when was the issue in terms of land getting depreciated, especially the farmlands that are transitional lands, which are at the edge of getting into the commercial or residential real estate. We carefully look for those lands which are good for good appreciation, and we select them. But anything can go wrong. So always invest with a caution, always invest after doing the due diligence. So on the land appreciation, when we get, this is always, as general partner, we set up a rule saying that we sell this particular land in 5 years. Typically, we take 5 years as a period. Some lands may end up taking a longer period or a shorter period, but then we always set the rules so that there is one captain for the ship. We decide on when the land would be sold, and this would be upfront, informed, and documented. There are conditions where if there is a very high appreciation in 3 years, and if there is a great offer, we will conduct a voting across all the limited partners, and based on the voting, majority voting, will take the decision. Let's say at 5 years, when we are trying to sell the land, if the market is not good, we will propose to hold on for a year more and conduct voting. Based on the major voting, we take the call. So this is completely done based on the voting, but at the same time, we control and we maintain the platform. VVF would maintain the professional management services. We handle all the legal and administrative activities. We manage the farmland until it's sold. This is to ensure that if there are any legal issues, we do upfront. We take the title insurance. We do the due diligence to ensure that this land is in the model for appreciation. And this is an example. Imagine if there is $1 million worth of land, and if you only have $25,000 to invest, you need 40 people to come to as a group to buy that land. Getting those 40 people together as an individual and managing the documentation, it's not very easy for individuals. That's where we created this model wherein we go through SEC guidelines. SEC is Security Exchange Commission. We file a Regulation D, a 506B or C, which is a security sale. This is the model that we use to create this platform. The SEC guidelines should not be taken very easy. Many people start a group and buy the land. As long as you are equal partners with decision making, you can go with an operating agreement. But if there is a manager involved, if the manager is declaring certain events, then all of them has to be in a private placement memorandum. So do not take SEC guidelines very lightly when creating any kind of groups to buy farmlands. VVF, we have SEC attorneys who will handle this for us. And we also have a very strong online platform to make the onboarding easy for individuals. So please read through all the terms and conditions before you invest with us. We would provide you PPM, which is a private placement memorandum. We would provide you a term sheet. Based on all this, you would sign a shareholder agreement. That's how you would onboard into the platform. And this is open only for accredited investors. Accredited investor is somebody who has a net worth of $1 million, who has a $200,000 income as an individual, or $300,000 income with the spouse. Only accredited investors are allowed to invest. And most of us would become an accredited investor when you look around, when you look at your assets. So if you have questions on the accreditation, you can always connect with us. This is me, Sashikant Vallam. This is my phone number, and this is my email ID. I'm also available on social media, on Facebook, Insta. So please feel free to connect with me. When we talked about land appreciation. When we sell the land, there is a model with which we distribute the shares, distribute the capital and the profits. I would explain that in a Excel. This is Excel that would be publicly available for you to play around. We are looking at per unit. This is an example of one of our current project where the offer price is $24,000. We'll just create a different one. All right, this is with an explanation. This is an example of our existing offering, wherein the offer price is $24,000. We are expecting it to be doubling in 5 years. And so we have mentioned the profit, estimated profit as 100% here. When 100% is the profit, which means that we're getting 24,000 on top of the capital 24,000. The expected sale price after a whole period of 5 years is 48,000, which means there is a 100% profit. These are called hurdles. Hurdle is a term from syndication real estate syndication waterfall. Real estate syndication, in simple words, is about group of people coming together to buy an asset. The hurdle is a term that is used when an individual who is an investor gets the hurdle is the term that is used to explain the split between a general partner and a limited partner. In this example, when an investor invests the funds, we always want to ensure the investor gets the first 8% preferred annual return. Please focus on the terms. It's a preferred annual return, which means if you invest $100, you will have to first get the $8 on a yearly basis. If the land is held on for 5 years, which means 8% into 5 years, which is 40%. That's a first hurdle, which means that the first 40% of the profit is completely for the investor. And VVF, which is a general partner, will not have any share in that first 40%. The next threshold is up to 15%. 8 to 15% is 7%. 7% in 5 years is 35%. In this 35%, there is a split of 70 and 30 between the investor and the VVF, which means 24.5% goes to the investor, 10.5% gets into VVF. After the 15% preferred annual return, whatever percentage left is shared 50 and 50, which means out of 25, the investor gets 12.5 and VVF gets 12.5. If you look at in a 100% example, investor gets these 3, which is summing up to 77%, and VVF gets 23%. That's a total of 100%, which means when an investor invests $24,000 as a capital, investor gets back $18,480 plus the capital, and VVF gets $5,520. This is considered to be a platform fee. Consider this to be a service that is provided for the fees that is taken for the service provided. Let's look at a scenario where the investment didn't get into good appreciation. It's only, let's say, 30% appreciation over 5 years, which means that the investor gets the complete amount of 30%. VVF will not get any percentage, right? And let's say if the amount is 50%, the investor gets 47% because of the hurdles. First 40 goes to investor. In the next 10%, there is 70-30 split, which is 7 and 3. And in the next, there is nothing after that, which means the investor gets the maximum out of it. Only after investor makes a sufficient return, that's when VVFs will start getting the money. Even at 60%, if you see this, there is a 54% goes to investor and 6% goes to VVF. So this is how we want to ensure that the investor gets the maximum benefit, and only after investor gets the right benefit, VVF will start getting the money. And it's in the interest of VVF to ensure this land appreciates very high, so that the percentage of appreciation goes very high and VVF gets the money. Whenever we talk about VVF, it's the investors of VVF overall company, VVF AgTech Inc. So anybody who's interested to share even the VVF profit can always become a shareholder in the VVF AgTech Inc. so that they can get the benefit of share that VVF is getting. So this particular Excel will be shared along with the documentation so that you can play around and just look at what models that's available. Any questions? Please feel free to connect with me. Thank you all.